Okay. So I'll come to do the question on Lucky PLC, Super PLC, Adam PLC. This is just understanding. I've done a short video on intro group, so this question I'll move straight forward and do the intro group. But then you can watch that video. It's just a short video. I was trying to do before this, but then I I couldn't finish it, so I'll restart everything again. But intro group will be posted as well. Just a small note on intro group. Okay, so let's start. So basically, they've given you always when it comes to consolidation, they'll give you the profit and loss, then they'll give you the statement of financial position, right? Then they'll give you additional information which you are going to use to adjust. So basically, when it comes to consolidation, when it comes to consolidation, whenever you're starting, you want to want to consolidate your account. There are some workings that you're supposed to do, right? And we all know. So this is just a solution to the question. So there are some workings that you're supposed to do, right? So the first thing is, so what I'll do first is that I'll go through the additional information, then we'll start with the workings. All right, so let's do the additional information. I says that on 1st April 2024, Lucky PLC purchased 3.8 million of the ordinary shares of Super PLC for 13,800,000 in cash. So what basically means is that Lucky PLC purchased some shares of Super, right? So what you're supposed to do is that you always have to find the percentage of interest, right? Percentage of interest in the company that is being acquired. The company being acquired. So here we are saying that Lucky PLC purchased 3.8. So you always just need to find the shares and the company being acquired and look at the percentage of interest. So for example, if maybe he purchased 400 and the number of shares is 600, you just find out, so let's say number of shares 500. You just find out the percentage of interest, which is 80%, right? So you just look for the percentage of interest whenever a statement like this is given to you. So basically, this is just saying that Lucky PLC purchased some shares of a company. So all we need to do is that we need to find the percentage of interest. Now we are saying that if the percentage of interest is from 50% to 100%, then we are saying 50% to 100, yes, 50% to 100%, or 50 or more. Then we are saying that the person acquiring is a parent of the company being acquired. If it's from 20% to 49%, then we are saying that so this is mean that having a parent and a subsidiary relationship. Then this means that we have a parent and an associate relationship. So 20% 49 is parent and associate, 50% to 100% is parent and subsidiary relationship, right? So when you find that interest and it's 50 to 100, you say it's parent and subsidiary. If it's 20% to 49, you say it's parent and what associate. Now you are saying that he acquired this with cash, so this is basically the consideration that he bought the shares of the subsidiary for. Now we are also being told that the comprehensive income for the year ended 31st December of Super PLC is 2 million, right? So what you should take note is that when you're calculating the net asset, right, of the subsidiary, right, whenever there's comprehensive income, you choose the comprehensive income over the profit. So if you use a comprehensive income for your calculations, of the retained earnings instead of the profit for the year. So take note of that. So you always use comprehensive income if comprehensive income is given to you, instead of profit for the calculation of the net assets. That's the retained earnings aspect. Now, you have been told that at the date of acquisition, the fair values of Super PLC's assets were equal to the carrying amount, to the exception of plants, which had a fair value exceeding its carrying amount by 1.2 million. What this means is that there was a valuation done. There was a valuation done, and you always have to take note that fair value fair value supersedes uh, so fair value supersedes carrying amount. So what it means is that you always have to take note the adjustment that will be done on the fair value. So yeah, I've been told that there was an adjustment done on the fair value, which had a carrying amount, as its asset, with the exception of a plant which had a fair value exceeding its carrying amount. It means that we need to adjust our plant to 1,200. Basically, what does this mean? It means that we need to add back 1,200 to the cost of the plant. Because after valuation, the cost of the plant was seen to be having a higher value than the value that was kept or was recorded in the statement of financial position. So you adjust it by them. Then you're saying the plant has a useful life of 14 years. So this is going to help us to get to the depreciation, where we divide the cost by what the useful life. So we all know that depreciation is cost minus the scrap value, if there is, over what the useful life. So this is a 1 year this is a full year depreciation. But then if we bought the asset within some part of the year, we have to make sure that what we adjust the cost of the asset. We adjust what the depreciation. So you multiply by the number of months that you bought it for. So you have to take note of that as well, that if the asset was bought halfway to the year, we adjust the depreciation. But if it was bought at the beginning of the year, then we use what the full depreciation. Now, we are also saying that Lucky also purchased 1.68. So this one to 1.68 million of what Adon PLC in an exchange for 1,000 of its own shares. So what basically this means is that this acquirement of this should help you to identify also the percentage of interest in Adon. So it will help you to identify the percentage of interest in Adon. So where if it's 50 to 100, you are seeing it's a parent subsidiary. If it's 20 to 40 now, you are seeing it's what parent and associate. Then they are saying that he acquired these shares in exchange for 1,000 of his own shares. So it means that this is a share exchange. So this a share exchange occurred between Lucky PLC and Adon PLC, where the value of the share exchange is 1,000, which is the number of shares times the price per share, which is 4.7. So it means that this is basically the cost of the investment in Adon PLC. So this is how much Lucky PLC paid for Adon PLC. So it's basically the cost of investment. Now, Lucky PLC has not recorded the investment, so it means that you need to calculate the investment basically. And Adon PLC's retained earnings were 8,600,000 on 1st July. That is at the date of acquisition. So this will also help you to know the profits that with Lucky PLC. But so basically it's like this. So you invested in a company, right? And when the time that you invest, the retained earnings was 8.6 million. So basically, if you want to know the profit that the company made from the time you invested to the end of the year, you just have to compare the profit, the retained earnings that you came to meet towards the retained earnings at the end. Let's say retained earnings at the end was 10,000. So it means that between when you acquired the company to the end of the year, the extra profit the company made was 1,400. So if you want to find how much you are going to get from the investment, you just multiply the 1,400 by the percentage of interest that you've made. So, for example, if you acquire 20%, what it means is that from this 1,200, you are only going to get 280. So basically, this helps us to identify the profits that or the returns that we've made from our investment in a company. Hope that's clear. Now, the II is telling us that the non-controlling interest in Super PLC is valued at its fair value. Now, NCI has two ways of being valued. So, you value NCI at fair value, or you value it as proportionate of net assets. So, fair value just means that you are going to multiply the number of shares that the NCI is having. So when it comes to fair value, all we are saying is that multiply the number of shares of the NCI. So you find that percentage of the shares times the share price of the market, right, based on the NCI. So just multiply the number of shares that I go. So for example, if the NCI number of shares was 900 and the share price was 5, then it means that the fair value of the shares is what? 500,000. Take note that this share price is the share price of the subsidiary, because the subsidiary is the one that is going to hold the non-controlling interest. The second one is a proportionate of what? Net assets. So this is where we are saying that we multiply the percentage of the NCI. So for example, if the parent is holding 80% and the NCI is holding 20%, then if you want to find the NCI, you are saying that proportionate of net assets. So you look at the net assets at acquisition. So if the net assets, after you done your valuation, the net asset is maybe 20,000, then the NCI will just be 20% times what? Net assets. That will give us what? 4,000. So take note of the two difference, fair value and proportionate. Now, what you should take note is that if you value NCI, right, at fair value, right, if you value NCI at fair value, then your the goodwill, right, will be a full goodwill. So we'll have a full goodwill. So full goodwill means that the impairment, right, basically what you take note of full goodwill is that the impairment loss, right, will be shared. So if NCI is valued at fair value, the impairment loss will be shared between the parent and the subsidiary, where the subsidiary is the non-controlling interest aspect. So the impairment loss will be shared if NCI is valued at fair value. But if NCI is valued at net proportionate of the net assets, right? If NCI is valued at proportionate of the net assets, proportionate of net assets, then what we are saying is that the NCI, right, that is the goodwill, is not full. You have a partial goodwill. So in that instance, the impairment loss will be valued or will be borne. Let me see. Impairment loss will be incurred or borne by just the parent. So take note of it. So if the NCI is valued at fair value, the impairment loss will be shared by both the parent and the subsidiary in their proportion. So if this is 80%, it means that parents take 80% of the impairment loss. If subsidiary is 20%, it means subsidiary will take 20% of the impairment loss. But if NCI is valued at proportionate of net assets, the full impairment loss will be borne by what? The parent. So it means that you subtract the full impairment loss at the group retained earnings. So take note of this. So this basically means is that we are valuing the NCI fair value and we are having a market price of 3.5. So we just multiply the number of shares that you get for the NCI, right, by the share price to get what? Our NCI. And since it's valued at fair value, any impairment loss in the question will be shared by the NCI and the group retained earnings or the parent. We also told that impairment test conducted at IAN revealed that the consolidated goodwill was impaired by what? 150,000. So what this means is that we are going to impair our goodwill. Then this impairment loss, to take note that since NCI is now valued at fair value, this impairment loss will now be shared between what? The NCI and the parent, which is under what? The group retained earnings. group retained earnings. Now, it also tells you that additionally, an impairment loss of 40,000 is to be recognized in respect of what Lucky's PLC investment. So, because of the second investment that was made, so you realize that the second investment was made in Adam PLC. If we realize that that investment is also a subsidiary, then we subtract this impairment loss. If it's also an associate investment, we also subtract the impairment loss under investment in associates. So if the relationship is parent and associate, right, the impairment loss is subtracted, right? Impairment loss and that occurred between the parent and associate relationship is subtracted under investment in associates. Just like how the impairment loss between parent and subsidiary is subtracted under goodwill, this will be subtracted under investment in associates, right? Then you know that always when it's subtracted, it means that somebody else has to incur that impairment loss. So the rest of the impairment loss will now still be borne by the group retained earners. So this meaning that it's going to affect their profit. So when there's parent and associate relationship and there's impairment loss, you are supposed to less the impairment loss under what investment. Now, so that's why they are saying that. 40,000 payment of 40,000 recognized in respect of Lucky's investment. So you are going to have a working where you call investment in associates, where you are going to less impairment loss. Then when you also come to the group retained earnings too, you less what impairment loss as well. This is basically because the impairment loss is going to affect the parent share of profit. That's the investment that they are making. Now, the fifth one is saying that Super PLC on 1st November 2024, Super PLC sold goods to Lucky PLC for 200,000 at a gross profit margin of 40%. Now, I explained in a short video about how intra-group sales works, right? So what you should take note is that intra-group sale can be between parent to subsidiary to parent to associate to parent. So I explained it already. So basically this we realize that when you solve the question or when you do the interest, realize that Super PLC is going to be the parent. So Super PLC is going to be the parent. Super PLC is going to be the subsidiary and Lucky is going to be the parent. Now, if it's from subsidiary to parent, which is this part, basically what we do is that there are some entries you are supposed to do. So when you watch the other short video, make sure you watch it. You watch the other short video before this. When you watch the other short video, realize that if it's between subsidiary to parent, we will debit our sales revenue. So in this instance, we are going to debit our sales revenue. Then you credit our cost of sales with the value of what? The sale. Now, we have to take note that the value of this sale we are talking about should be sales done in the post-acquisition period. So always have to take note that the sales that we are eliminating because of intra-group sale, we should make sure that the sale that is eliminated is a sale done after the acquisition. So between Super PLC and Lucky, you'll be told that Lucky acquired Super PLC on 1st April, right? And this sale was done on 1st November. So this is after the acquisition. So because of that, we can eliminate the whole 200 cities. But in case this 200 cities wasn't done for the whole after the acquisition, then it was done before the acquisition, then you have to apportion it. So take note of that. So if it's done before the acquisition, we have to apportion. So let me give an example. So let's say the sale. So the acquisition day was what, 1st April. So let's say on 1st January, the sale done on 1st January was 200,000 for the whole year. But then the acquisition was done on 1st April. Now what it means is that we can only eliminate post-acquisition period, which is 1st April to 31st December. So it means that the sales done between 1st January to 31st March will not be eliminated. You get it? So it means that the only number of sales we are going to eliminate is what? Is 9 out of 12 of what? The 200,000. You get it? So that's the percentage you eliminate. By this instance, this 200,000 was the sales occurred on 1st November, which is post-acquisition. So the whole 200,000 will be what? Eliminated. So take note of that. So this is from subsidiary to parent. So rather than the other video, we'll see would there be sales revenue, then we'll credit what? Cost of sales. Then the other transaction is that you debit cost of sales, then you credit what? The inventory. Then if it's from subsidiary to parent, you further on. So let me do this. So you debit sales revenue and credit cost of sales with the value of the goods. So this instance, it will be the 200 that you debit and credit. And after you are done, you are supposed to find out if there was unrealized profit, right? You are supposed to find out if there's unrealized profit. So you realize that they tell you that all goods were still with Lucky at the year end, right? So it means at the end of the year, Lucky PLC didn't sell any of this. So what it means is that there's going to be an unrealized profit on this value. So it means that the unrealized profit will be 200,000 times what? 40%, which is what? 800, right? So this 800 is going to be what? Our elimination. So we are also supposed to eliminate this unrealized profit, and we eliminate unrealized profit by what? Debiting our cost of sales, then you credit what? Our inventory. Then you further on go on, right? Now if it's subsidiary to parent, you have two options. It's either one, we reduce our net asset of subsidiary, right? Net asset of subsidiary by the unrealized profit. Or two, we share the unrealized profit between the parent and subsidiary. So but then it's advisable always to use the first one, which is the reduction of your net assets by what? The unrealized profit. So always when it comes to the workings for unrealized profit always have three entries. You debit cost of sales, then you credit inventory, then you further on use your realized profit to reduce what? Net assets of subsidiary if the sale is from what? Parent, is from subsidiary, to parent. Now if it's from parent to subsidiary, all these are the same. You debit sales revenue, you debit cost of sales, you debit cost of sales to unrealized profit, you credit inventory to unrealized profit. But the only difference is that if it's from parent to subsidiary, right? If it's from parent to subsidiary, what you do is that instead of reducing the last part, so this part, if it's from subsidiary to parent, you are reducing the net asset of the subsidiary by the unrealized profit. Now if it's from parent to subsidiary, you rather reduce the group retained earnings by the unrealized profit. So just take note of this. You rather reduce the group retained earnings by the unrealized profit. So this is the difference between sales from parent to subsidiary and from subsidiary to parent. Now the other one is saying that after acquisition, Adum PLC sold goods to Lucky PLC for 400,000 at markup, right? Now what also means that, so this, we realize that when we realize that this is associate and this is what? Parent. Now in the other video too, the transactions has been explained there. Now if it's from associate to parent, what we are saying is that we are treating the associate as a third party we are treating the associate as a third party. So what occurs in that instance is that the sales that occurs between the parent and associate is not eliminated. So the sales is not what's eliminated. We don't eliminate the sales between what? The parent and what? The associate. Right? Or the associate and parent. But what is eliminated is just the unrealized profit. So you need to find the realized profit on unsold goods. So after acquisition as well, so Adon PLC sold goods to Lucky PLC. This is from associate to parent, and for 400,000 at a markup. So always make sure that if markup is given to you, you change markup to margin. How do you change markup to margin? Margin is equal to markup over 1 plus markup. So the percentage I get, so for example, this is 25% markup. So margin between 5% over 1 plus 25, which is 20%. Then it means that the unrealized profit on the unsold goods. So you are saying that a quarter of these goods remained. So after sales were made, a quarter was remained. So the unsold goods is 1/4 of the 400,000. So what it means is 100,000 was remained. Then it means that the markup or the margin is 20%. So the unrealized profit will be what? 200. Okay, 2,000. So that's 20. So let me just do it. If you are working, so this will be 20%. Yeah, that will be 2,000. Yeah. So it means that the realized profit here is what? 2,000 in this instance. Yeah. So now what happens is that when it comes to the unrealized profit between associate and subsidiary and parent too, the whole unrealized profit is not borne by the parent, right? The parent will only take the share of his interest. So if the parent is having a 30% interest in associate, the percentage of the realized profit will be 30%, which will be what? 600. So you see, when it comes to parent to associate, we record the full unrealized profit. But when it comes to associate to parent, we only record the parent's portion, which is what? The percentage. Take note of that as well. Then the entries, when it comes to parent associate to parent, the entries are basically you debit what? So you associate to parent, you debit the retained earnings of the associate, you credit the inventory of the parent. So always take note that realized profit as what? A three entry. So you debit retained associate, you credit inventory of the parent. Then the last one is for you to reduce the parent share of the associate's profit. Parent share of associate's profit. Parent share of what? Associate profit by the unrealized profit as well. And thinking that this unrealized profit is not the full, it's just the parent's share of the unrealized profit. So basically that's the VI. Then the last information is telling us that at the first December, Lucky's PLC current account to Super PLC was 130,000 credit. This did not agree with the equivalent balance in Super PLC's books due to cash in transit, which was not received until 2nd January. Now, if current account has a credit balance, right? If current account has a credit balance, we are looking at current liabilities or trade payables. So if it has a credit balance, we are looking at current liabilities or trade payables. If it has a debit balance, then we are looking at the current assets or trade receivables. So if current accounts are credit balance, current liabilities or trade payables are debit balance, you are looking at current assets or trade receivables. So this is an instance where Lucky PLC's current account with Super PLC was 130,000. You get it? So now this did not agree with the equivalent balance in Super PLC's books due to its cash in transit. Now what they are saying is that this 130,000 did not agree. Right. So now we are just trying to cancel it out. So now this has a credit balance. It means that it's a trade payable. If you want to cancel trade payable out, what do? You debit it. So what you just do is you debit your trade payable. Right. You debit your trade payable with 130,000. Then they say it didn't agree because of cash in transit. So it means that the cash too was not received. So you have to record it as a cash that we are going to receive. So we also debit cash of what? 70,000. Then basically the other credit entry is that because now we are reducing our trade payable and we are increasing our cash. It means that our trade receivable from the subsidiary side is going to reduce. So you credit your trade receivable by the total, which is what? 200,000. So basically that entry, that is it. So because parent account is of a credit balance a trade payable, you debit it to reduce it, right? And we have cash too. So the cash would increase the cash in transit, or the cash that we have. Now basically what we are doing that we are reducing our trade payable, right? We are reducing how much the person is owing us, and you're also increasing the cash because we're expecting cash. That means that in totality, the total value of the debtors amount that we are reducing is basically what? 200,000, because we are cancelling out how much he or she is owing us. We are also increasing the cash that is going to give to us, and basically means that the total amount that we are going to reduce in our books due to all this transaction from the trade receivable side is what? 200,000. So basically this is about the additional information. So I'll move straight forward into solving the questions. If you have any question related to this, you can text me 0546344074, and I'll do my best to help you. Yes, so my name is Jeremiah. So basically that is it. I will also I'll end this video and start the actual video of solving the question. So we are expecting that maybe this question will come. So just take your time and go through the additional information one more time before you watch the actual video. Right. But this is just a brush through the additional information. We are now coming to do the actual question. So I'll end this and I'll upload the other one as well.